Hello everyone, and welcome to our lesson, our first one about futures contracts. So what exactly is a futures contract? On the right, you can see that a futures contract is similar to any other financial product. It's similar to crypto, it's similar to Forex, it's similar to stocks. At the end of the day, it's a product that's traded on the financial exchange. It's traded on the futures exchange, and we can trade this asset for day trading just like we actively trade stocks, Forex, and crypto. At the end of the day, you can basically buy and sell it if you want, as you can see. In other words, I can buy it and I can also sell it. But let's understand the nature of a futures contract and its characteristics, because it's a bit different from other financial products. So, first of all, a futures contract is an obligation or agreement to buy or sell the underlying asset in a financial contract. Now let's understand what an underlying asset is. As we know, a futures contract is a leveraged product, and it is derived from a certain underlying asset. For example, a futures contract that is derived from gold, or a futures contract that is derived from the Nasdaq index, or a futures contract that is derived from oil. Now, because a futures contract is the financial product derived from a specific underlying asset, like for example gold, oil, and so on, this product is leveraged. Later on, we'll also understand what leverage is. And of course, we'll also learn how to assess the value of the contract and how to interpret the numbers. So as we clearly know up to this point in our discussion, we fully understand that a futures contract is essentially a binding commitment to either buy or sell the underlying asset. What does that mean? In practice, it looks exactly like this. Let's take an example where I just bought a contract, futures contract. Right now, as you can see, I bought one futures contract. In other words, I bought a commitment, which is essentially an obligation to purchase the underlying asset at a specific point in time. Why did I do this? Well, because since I bought a contract, and if I buy a contract, specifically a futures contract, that means I'm buying a commitment, and if I buy the commitment, I have to fulfill the commitment and buy the underlying asset. And it's the same if I sell as well, the financial futures contract. If I sell the futures contract, I'm basically selling a commitment. And if I sell a commitment, I have to fulfill that obligation. And how do I fulfill it? By having to sell the underlying asset that I made the commitment for. Now, you're probably asking yourselves, wait a minute, if you're now actually buying a futures contract, then when exactly do you have to fulfill your obligation? Or in other words, when does the settlement take place? Your obligation and buy the underlying asset. For example, if you are currently buying a Nasdaq futures contract, which is commonly referred to as the NQ, are you actually obligated to buy the underlying asset, which is the Nasdaq index? And I'll answer that question now. The short answer is on the expiration dates. Notice that next to every contract name, you will also see that there are numbers displayed. For example, the numbers 12 and 25. These numbers are not random. They are placed there for a specific reason. What this actually tells me is that this contract expires in December of the year 2025 specifically. That means if I purchase a contract right now and I simply hold on to it without making any changes or adjustments, this contract until the specified expiration date, that means I'll definitely have to meet all of my obligations. For example, making sure everything is settled on time. But if I decide to close my position before the contract's expiration date, for example, if I simply and straightforwardly close the position now and sell the contract back, I'm not obligated to anything because right now I don't have a contract. And that's all we want to do. Our intention is clear. We don't want to retain possession of the contract beyond just a few hours or even beyond a single day. We want to buy and sell and buy and sell. During the business day, we usually not interested in holding this contract after the trading day, and neither do we interested in holding this contract on its expiration date. But it's important that you know how this works. And theoretically, if right now I buy a futures contract and I patiently wait until the expiration date of the contract, I am supposed to fulfill my obligation And what is my obligation? If I bought a futures contract, I am supposed to buy the underlying asset. And if I sold a futures contract, I'm supposed to sell the underlying asset. As you can clearly see, we have 4 expiration dates. We have an expiration in March, in January, and in September, and in December. As you can see, we are now at this particular point in time, indeed in the very last quarter of the year. And therefore, we see a contract whose expiration date is in the month of December right now. In the next lessons, I will expand and clarify this even further. And of course, we will talk about leverage, what a tick is, and what the point is. Alright, we'll meet in the next lesson. See you. Bye bye.